Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kohl's Corporation Annual Report. Kohl's Corporation offers a wide range of products through its stores and website. The company provides apparel, footwear, accessories, beauty products, and home products to its customers. Some of the notable brands offered by Kohl's include Apt, 9, Croft & Barrow, FLX, Jumping Beans, Sonoma Goods for Life, and Tech Gear. Additionally, Kohl's also carries popular brands such as LC Lauren Conrad, 9 West, and Simply Vera Vera Wang. Kohl's operates as an omnichannel retailer, allowing customers to shop both in-store and online. This convenience enables customers to browse products from the comfort of their own homes or visit one of Kohl's many locations across the United States. By offering a variety of brands and products under one roof, Kohl's aims to provide its customers with a comprehensive shopping experience. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be complex and multifaceted. However, based on the extracted summaries, several key factors stand out. Net sales penetration by line of business and brand type are significant drivers of revenue growth. For instance, a strong performance in apparel sales can contribute to overall revenue growth, while a decline in footwear sales may have the opposite effect. Similarly, the success of national brands versus proprietary brands can also impact revenue. Consumer spending habits, including demand for merchandise, are another crucial factor. Economic conditions, such as inflation and interest rates, can influence consumer confidence and spending patterns. Additionally, changes in global trade policies and tariffs can also impact revenue growth or decline. Other important drivers include inventory management, store traffic and sales conversion rates, brand image and reputation, pricing and competitive practices, and effective marketing and loyalty programs. These factors can all contribute to a company's ability to attract and retain customers, ultimately driving revenue growth or decline. In summary, the primary drivers of revenue growth or decline are complex and interrelated. However, by focusing on key areas such as net sales penetration, consumer spending habits, economic conditions, inventory management, brand image, and marketing efforts, companies can better understand and address the factors that impact their revenue. The net income of the company underwent significant fluctuations over the period under review. Initially, it decreased by a staggering 80% from $317 million to $64 million due to various factors such as higher effective tax rates and lower favorable impacts from uncertain tax positions and federal tax credits. However, this trend was reversed on page 32, where net income increased by $129 million, although the percentage increase is not specified. The subsequent period saw a substantial increase in net income, rising from $648 million to $1,380 million, representing an impressive 111% growth. This significant improvement can be attributed to various factors, including changes in revenue streams and cost management strategies. In terms of profit margins, there were mixed trends observed. While the gross margin improved by 34 basis points to 37.5%, operating income as a percentage of total revenue increased by 135 basis points to 4%. However, adjusted operating income as a percentage of total revenue remained relatively stable, increasing by only 2 basis points to 3.3%. Interestingly, the company's profit margins were negatively impacted in certain areas, such as other current assets, where it decreased from $309 million to $272 million. Overall, the net income and profit margins of the company exhibited significant fluctuations over the period under review, reflecting the dynamic nature of its financial performance. The company's financial performance indicates a positive trend in its operating cash flow. The data from 2023 to 2025 shows an increase in operating cash flows, with the highest amount recorded at $1,380 million in 2025. This significant growth suggests that the company is efficiently managing its operations and generating sufficient cash to meet its financial obligations. Furthermore, the consistency of positive net cash provided by operating activities across all 3 years reinforces this conclusion. Overall, these figures indicate a strong financial position for the company, with a clear ability to generate positive operating cash flow. The company's debt level has undergone significant fluctuations over the past year. While there was an initial increase of $262 million, this was partially offset by a decrease of $87 million through debt repurchases and a reduction of $353 million in the current portion of long-term debt. However, the issuance of senior secured notes led to an aggregate principal amount increase of $360 million, resulting in a net debt increase from $49 million in 2024 to $540 million in 2025. In terms of interest expenses, there has been a mixed trend. On one hand, interest expenses decreased by 9.7% from $319 million to $288 million. However, the notes due May 2031 saw an increase of 175 basis points, which may lead to higher interest expenses in the future. Additionally, changes in interest rates on outstanding borrowings under the revolving credit facility could also impact interest expenses. Despite this, interest expenses did decrease from $312 million in 2024 to $295 million in 2025. Management's outlook for the company is centered around several key strategies. Firstly, they prioritize integrity and invest in employee training and career growth, focusing on areas such as merchandise mix, brands, service, loyalty programs, credit availability, and customer experience. Differentiating Kohl's in the marketplace through marketing and loyalty programs will strengthen customer loyalty and increase sales. Investing in private brands and partnerships with national brands is a key strategy for success. Management expects net sales to remain flat or slightly decrease by 2%, while adjusted operating margin is expected to range from 2.8% to 3.4%. They also anticipate generating approximately $350 million to $400 million in capital expenditures. In addition, management plans to continue driving value to customers, investing in the business, paying dividends, reducing debt, and returning excess cash to shareholders. The company will resume share repurchases over the long term once overall leverage improves. To achieve these goals, Kohl's is focusing on restructuring efforts, including closing underperforming stores and e-commerce fulfillment centers, resulting in cost savings. Overall, management's strategy focuses on improving customer experience, investing in the business, and generating financial returns for shareholders while reducing debt and returning excess cash. The company's financial activities have been transparent and consistent with its shareholder value creation strategy. One of the key indicators of this commitment is the payment of dividends to its shareholders. As per the provided information, the company has indeed paid dividends on multiple occasions, as mentioned in pages 15, 21, 24, and 31. Furthermore, the company has also demonstrated a proactive approach towards enhancing shareholder value by buying back shares. This strategic move not only boosts the company's stock price, but also reflects its confidence in its future prospects. As noted on page 44, the company has successfully executed share buyback programs, thereby creating value for its shareholders. Concerns about inventory buildup or supply chain disruption. The extracted summaries reveal several concerns regarding supply chain disruption and inventory management. Pages 5, 6, 7, 13, 14, and 40 specifically mention issues related to supply chain disruptions. For instance, page 32 notes a significant operating cash outflow due to payments to merchandise vendors, which may indicate strain on the supply chain. Furthermore, pages 26, 27, 31, 32, and 34 highlight efforts to mitigate these disruptions through cost reduction measures, improved working capital management, and increased cash reserves. However, page 35 expresses concerns about inventory valuation and shrinkage rates, suggesting potential issues with inventory management. While there are no specific concerns mentioned about inventory buildup on certain pages, the overall trend suggests that the company is grappling with supply chain disruptions and inventory management challenges. That concludes the financial summary for Kohl'S Corporation. Feel free to comment below, and I will be happy to answer them when possible.